If a stock in your portfolio loses 50% of its value, what return do you need to recover your original investment? Hi everyone and welcome back to the channel. I'm Lorenzo and today we're going to break down some important calculations to explain the math behind the stocks, especially when it comes to losses. I know some of you might think this topic is a bit basic, but it's definitely worth clearing up, especially if you're new to the stock market. If you enjoy content like this, don't forget to subscribe to the channel, it really helps, and I post regularly on investing, risk, and long-term strategy. So, back to the opening question. If your stock drops 50%, what return do you need to recover? Most people would probably say that you need a return of 50%, right? It sounds logical, you lose half, gain half, and you're back to where you started. But that's actually wrong. The real answer is 100%. Since the percentage gain is calculated from your new lower price, going from 50 euros back to 100 euros means you need to double your money. That's a 100% gain. And this little detail changes everything about how we should think about losses, risk, and recovery in investing. Let's say you've got 100 euros invested. If you lose 50%, you're down to 50 euros. Now, to get back to 100 euros, you'd need to make another 50 euros. But that 50 euros gain, from 50 euros to 100 euros, is a 100% return. So no, a 50% loss doesn't require a 50% gain. It requires you to double your money just to break even. And the deeper the loss, the steeper the climb back up. To recover from a loss, the required gain is always higher than the percentage lost. For example, if you lose 10%, you need an 11.1% gain just to break even. If the loss is 20%, then a 25% gain is necessary to recover. With a 30% loss, you will need a 43% gain. The gap widens significantly as losses increase. After a 60% loss, you need a 150% gain, and a 70% loss requires a 233% gain. Finally, recovering from an 80% loss demands a whopping 400% gain. As you can see, once you go beyond 30–40% losses, recovering becomes exponentially harder. And this is where a lot of investors get burned, especially during market crashes or emotional sell-offs. Now, beyond the math, there's also a psychological trap that comes into play. When we lose money, we naturally want to make it back fast. So what do most people do? They take on more risk, they jump into trades they don't fully understand, they chase high volatility stocks or try to average down without a real plan. That desperation to recover quickly, it usually makes things worse. We end up overtrading, revenge trading, and instead of climbing out of the hole, we just keep digging. Let's talk about a few of the most common mistakes investors make after taking a big loss. First, averaging down without a strategy. Just because a stock is cheaper doesn't mean it's a better deal. You might just be doubling down on a bad decision. Second, ignoring stop losses, if your trade is not medium to long-term oriented. Third, putting too much of your portfolio into a single bet. If you're not knowledgeable enough about the company, one bad trade shouldn't be able to wipe out your progress. So, what should you do instead? Here's what smart investors focus on. They manage risk first. They size their positions based on risk, not on how confident they feel. They diversify in a smart way, not spreading themselves too thin, but not going all in either. And most importantly, they zoom out. They think in years, not days or weeks. Remember this quote from Warren Buffett. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. So, what's my personal strategy when one of my stock drops 50% or more? It happened to me more than once, and here's what I've learned. I follow 3 core principles. First of all, I never invest all the money at once. I build my position in steps. Second, I average down only when the fundamentals still look strong. 3. I stay invested and stay patient. Let me explain. When I decide to invest in a company, I don't buy the full position right away. Usually I start with 50% or even less of the amount I'm planning to invest. Then I follow the company even closely, checking earnings reports, strategic moves, and long-term growth. If everything keeps moving in the right direction and the fundamentals are still solid, I consider adding more capital to complete the position. Now here's the important thing. If the stock drops, let's say, from 100 euros to 50 euros and I haven't completed my position yet, I see that as an opportunity, as long as the fundamentals haven't changed. At that point, I double the investment at 50 euro to complete the position. What happens? My average cost now becomes 75 euros instead of 100 euros. This means I don't need a 100% recovery anymore to break even. I just need the stock to go from 75 euros back to 100 euros, which is a 33% gain. What about the worst case scenario? Let's be real, sometimes the stock will not recover. In that case, there are still smart things you can do. You can sell the full position and use the loss to offset capital gains taxes from other stocks you sold in profit. Or you might sell just part of the position, lock in some tax savings, and buy it again to get a better cost basis going forward. These are strategic moves, not emotional ones, because that's what smart investing is about: managing risk, thinking long term, and making every situation work in your favor, even the bad ones. If this video helped you look at risk a little differently, hit the like button. It really supports the channel and tells YouTube this is content worth showing. And if you haven't already, consider subscribing. I post weekly videos to help you become a smarter, more confident investor without the noise. Now I've got a question for you. What's the biggest loss you've ever had in the markets, and how long did it take you to recover? Drop it in the comments, I'd love to read your story, and I'm sure others will learn from it too. Thanks for watching, and I'll see you in the next one.